Okay, let's continue talking about termination. Termination. You're terminated. You're fired. All right, we're firing you. Now, what does termination talk about? Termination basically says we've got this partnership, and what's happening is we're ceasing the business. So we're ceasing the business. Now, in ceasing the business, what it says is when a partner wishes to sell their interest to another partner, the amount realized is the sum of. So how much is realized? It says the cash and the property received plus the relief from debt. The relief from debt. Now, what we're trying to do is we're trying to say, there's kind of a special rule here. Normally, as we said earlier, like when you sell this thing, it's generally considered a what? A capital gain. So for example, let's say I'm liquidating, I'm selling out, and I go, here's 10 and I got 15, boom, here's a $5 gain, and I said it's generally a capital gain. Okay, that's great. But there's some special rules, and let's think about it for a minute. Because what's happening here is if, for example, I didn't sell my share of the partnership and I didn't leave. If I stayed, if receivables went up or inventory changes, if I have any kind of income from inventory or receivables, what is inventory or receivables considered? Those are considered what? A current asset. Those are considered business assets. Any kind of gain from that would be what kind of gain? Any gain from that would be an ordinary gain, right? Because inventory, receivables would be considered an ordinary asset. Ordinary assets create ordinary income, not a capital. So because of that, what it says is these inventories and receivables are called hot assets. Those are called the hot assets of the business. So you remember we talked about ordinary assets, and we'll define it in another section with property. An ordinary asset would be inventory and receivables. Ordinary assets create ordinary income. So if I'm a member of the partnership and I stayed a member of the partnership and we had some sales and I had some receivables and I collected it, that results in ordinary income. But by taking my interest and selling it to someone else and selling my interest, basically it resulted in a capital gain. So what I did by selling it is I resulted in a capital gain instead of an ordinary gain. They go, oh. So because of that, we're going to look to see that if there's an unrealized income because of the inventories and receivables on those hot assets, that part would be considered an ordinary gain. The rest would be a capital gain. Now, it doesn't relate to what we call a cold asset like capital assets. Capital assets, cold assets, whereas these inventory and receivables are the hot assets of the business. All right, for example, if you look in your notes, it says under termination, for example, assume Ronnie Remainder and Sammy Seller are equal partners in the RS partnership and that the partnership, which reports on a cash basis, has the following balance sheet. It says tax basis, fair value, cash, receivables, goodwill. Now notice the receivables. The tax basis 0, but the fair value is 300. So it went up, 300 went up. If I own 50%, half of 300 would be my share, which is 150. Then it goes down and it says liabilities, it says R capital 25, SS capital 25, total liabilities, and so on. Bobby Buyer purchases Sammy's 50% interest in the partnership, paying him $375 cash based on the fair value of the partnership and assuming Sammy's share of liabilities. In this transaction, the sale proceeds to Sammy are $425, including the cash received and the debt relief, because we're looking at net debt relief as value as well. Sammy's basis in the partnership before the sale was $75. Including the capital accounts tax basis of $25 and Sammy's share of liabilities. Don't worry, I'll put this into English in a minute. The gain on sale reported would be $425 minus $75 or $350. Okay, so let's see what's happening here. Here's what's happening. Well, I hate to erase that. All right, let's do this here. So here's what's happening. All right. It says actual cash proceeds. So proceeds and cash $375 plus your net debt relief was 50. So that means that the amount that is realized is 425. The basis in the partnership was only 75. Therefore, we have a gain or a loss, in this case, a gain of 350. So basically, I'm selling for 375 plus the net debt relief of 475. My basis, so my outside basis, if you did it this way, my outside basis is basically 75, and I got 425, which means, oh, I've got a gain of 350. And as we said earlier, oh, that gain is going to be a capital gain. But here's the deal. it is going to be considered an ordinary gain for the increase in value of inventory and receivables. Receivables went up by 300. I own 50% of that, or 150. So of the 350, the first 150 is ordinary, the other 200 is capital. Let's look at that. Under that box it says ordinary gain or loss for inventory, capital for everything else. Next paragraph. There is, however, one possible complication. This is it. When a partner sells their interest, the amount the buyer is willing to pay is based on the fair value of the assets and liabilities, and not on the tax basis. If the partnership has unrealized ordinary income assets, inventory and receivables, called hot assets at the time of sale, the partner has effectively converted income that would have been ordinary to capital. To prevent this, the gain on sale of the partnership must be reported as ordinary to the extent of unrealized ordinary income assets. The rest is considered capital. So putting that into English, because receivables went up, that means that came from sales. That would have been ordinary income. Therefore, half of that is mine. That means 150 is ordinary. The rest is capital. So it's not quite as straightforward as just the difference is capital, because we have to look at what we call the unrealized ordinary income items.